Welcome to the Deep Dive, where we cut through the noise for those essential insights. Today, we're digging into the recent second quarter 2025 earnings from Coca-Cola FEMSA.
Right, the world's largest Coca-Cola bottler by sales volume.
Exactly. And what's really fascinating here is seeing how a giant like this handles, fluctuating economies and, well, some pretty wild weather.
Absolutely. Our mission here is really to unpack the key takeaways from their Q2 earnings call and the press release.
So you, the listener, can understand how a company this big navigates challenges and plans for growth across, well, really diverse Latin American markets.
Yeah, it's about understanding the why behind the numbers, not just the what, how their strategies play out in a tough environment.
Okay, so let's start with the big picture. The consolidated view for Q2 2025, overall volume, it dipped 5.5%, came in at just over a billion unit cases.
1,035.3 million to be exact. So a noticeable dip.
But, and this is the interesting part, total revenues actually grew 5.0% reported, hitting almost 73 billion pesos.
All right, so 72,917 million. And even currency neutral, that's still up 2.4%.
So lower volume, higher revenue. That points to strong revenue management, maybe some favorable currency effect.
Definitely both.
Yeah.
It shows they're able to extract more value per unit, even selling fewer units. That's crucial when things get tough economically. Speaks to their pricing power.
But it wasn't all smooth sailing on the profit side?
No, gross profit was up 3.4%, but the margin actually shrank,
Yeah.
contracted by 70 basis points, so 0.7%, down to 45.3%.
Why the margin pressure then?
Well, a few things. Lower operating leverage, basically fixed costs spread over fewer units,
Yeah.
also an unfavorable product mix, and just generally higher fixed costs.
Okay.
Though they did offset some of that, better sweetener costs helped, and they had some smart raw material hedging in place.
And how did that flow down to operating income?
Operating income was pretty much flat, up only 0.2% to SAN 9,767 million. So the margin there also contracted by 60 basis points.
And the bottom line, majority of net income.
That actually decreased 5.3%, down to Fatau's 5,312 million.
So mixed results overall. Revenue up, volume down, margin squeezed, net income down. What did the CEO make of all this? Did they see it as just temporary blips?
That seems to be the take. The CEO acknowledged it was a challenging environment, specifically pointed to a softer macroeconomic backdrop in Mexico and that adverse weather in both Mexico and Brazil.
Uh-huh.
But crucially, they emphasized that their long-term perspectives remain unchanged. So, yes, they view these as headwinds, not sort of fundamental problems.
And they're leaning on their internal capabilities and their partnership with Coke.
Exactly. Leveraging their capabilities and strong partnership with the Coca-Cola company, that was the phrase used, to navigate the short term while keeping eyes on the long-term prize.
Okay, so the big picture shows resilience, but also some real pressures. Let's zoom in, right? Where did the action really happen? Mexico and Central America first, especially Mexico, their biggest market. Sounds like it was tough there.
It really was. Mexico's volume dropped a substantial 10%. Now, part of that is because they were comparing against a really strong quarter last year.
Right, tough comps.
Tough comps, exactly. But the main issues were that softer macro environment and, honestly, just terrible weather.
How bad was the weather?
Pretty bad for selling cold drinks. June temperatures were 3 degrees Celsius lower than last year. And rainfall, 5 times the norm. Mexico City had its rainiest June in over 50 years.
Wow, okay. That would definitely hit consumption.
Absolutely. People just weren't reaching for cold beverages as much.
So faced with that, what did they do? It obviously didn't just, wait for the sun to come out.
No, definitely not. They got quite strategic. Adjusted promotions for both single serves and multi-serves. The focus was on actions that not only address the short term, but also provide sustainable share of value.
Thinking longer term, even with promotions.
Precisely. And they rolled out a big affordability plan with the Coca-Cola company. Things like upsizing packages, adjusting prices on key returnable bottles to hit attractive price points.
Affordability is key in softer economies.
And they really backed it up, dedicated more than 33,000 cooler doors just to affordability products. That's a serious commitment.
And did it work? How was their execution on the ground?
Seems quite strong. They hit historic levels in portfolio coverage, improved order fulfillment, better net promoter scores, so happier customers.
What about market share, though, with that volume drop?
It's a bit mixed. They did better than last year in the modern channel, supermarkets and the like,
Okay.
but they're still lagging, about 1.5 points below in the crucial traditional channel. the small mom-and-pop stores.
Any specific area they're struggling in?
Yeah, they pinpointed a gap around the 20 pesos area.
Yeah.
That's where they're getting hit by competition like Pepsi's 1.75-liter and Red Cola's 2-liter bottles. So it's a very specific price point battle.
Interesting. And despite these immediate fights, they're still investing heavily in Mexico.
Oh, absolutely. Long-term view. Expanding the warehouse in Toluca, 19,000 square meters.
Yeah.
A brand new peat line there. Huge capacity, 5 million unit cases a month. Plus expanding in San Juan del Rio, upgrading the Villahermosa distribution center. It's all about building capacity and efficiency for the future.
Okay, let's stay in that division, but look at Guatemala. A different story there, I gather.
Completely different. Guatemala saw volume increase 1.6%.
How'd they manage that?
Primarily by adding new customers. 10,000 new customers, actually 28% ahead of their target.
That's impressive growth.
Yeah, and it led directly to share gains. Sparkling beverages, juices, water, energy drinks, pretty much across the board. They also beefed up the sales force and infrastructure, put in almost 10,000 new coolers just this year.
And digital played a role there too, the Chuntos Plus program.
It did. Their loyalty programs, Chuntos Plus and Chuntos Plus Premier, added 7,000 new monthly active users. And over 60% of those are active, which shows good engagement.
Solid results. And infrastructure.
Also moving forward, a new can line started in April, and they're assembling new PT line right now. So Guatemala is definitely a bright spot.
All right, let's pivot to South America now. More of a mixed bag here. Starting with Brazil, volume dipped slightly.
Yeah, Brazil volume was down 1.5%. And again, weather was a big culprit. Colder temperatures, especially in June. Sao Paulo was 3 degrees cooler than last year.
Seems like weather was a theme across the board this quarter.
It really was. But here's the interesting part in Brazil. Despite that small volume dip, they actually hit record share in the non-alcoholic ready-to-drink segment.
Record share. Even with lower volume, how?
By gaining share across categories, sparkling, juice, sports drinks, water, basically outperforming the market even as the market itself perhaps shrank a bit due to weather.
Strong execution.
Any particular product standouts? Coca-Cola Zero. Just phenomenal growth, up 56% compared to last year. It now makes up 27% of their total volume mix.
27% for Coke Zero. That's huge.
It's a massive shift towards sugar-free options there. And their single-serve mix also ticked up 1.6 percentage points higher, now at 27.1%.
And the digital story continues strong in Brazil.
Very strong. Digital customer base grew over 12%. They added 28,000 active monthly users. And those users are spending more, average ticket size up nearly 13%.
Wow.
And that Chuntos Plus premium loyalty program, it jumped from 18,000 redeeming customers to over 59,000. Huge increase in engagement.
What's driving that digital success? Anything specific?
Well, they highlighted this Chuntos Plus Advisors tool. It's boosting the efficiency of their sales force significantly, like over 11 percentage points better geo-efficiency. And they're expanding beverage coverage with it.
And they plan to use that elsewhere.
Yes. That's the key takeaway. They're planning to roll it out in Mexico around August or September. So taking a successful digital tool and scaling it across markets.
Smart. And one more thing on Brazil, the Porto Alegre plant recovery after the floods.
Oh, yeah, that's a remarkable story of resilience. The plant was badly hit by floods earlier, but now it's back to 100% capacity, both production and distribution. They went from having only 30 products available in May last year to 180 by June this year. Full portfolio back by July.
That's incredibly fast.
It really is.
Yeah.
And they're already planning for the future, a containment wall project for 2026 to protect against future floods. Very proactive.
Okay, moving quickly through the rest of South America. Colombia.
Colombia saw volume down 2.8%, but they said it improved sequentially throughout the quarter. Gained share in key categories like sparkling, tea, sports drinks, flavored water. Again, affordability and execution were key. And expanding digital capabilities there, too.
And Argentina, that looked like a real positive outlier.
Yeah, Argentina was the star performer in South America. Volume up almost 12%, 11.9%.
What drove that? Just the improving economy?
That was a big part of it. Improving macro indicators, monthly inflation finally dipping below 2%. But they also capitalized on it strategically.
How so?
Mix of affordability, promotions, and a push on single-serve growth with something called the Sheraco campaign. And digital is accelerating fast there, too. Digital customer base jumped 13 points to over 30%. Order fulfillment hit 98%. So good execution meeting better conditions.
Got it. So across all these markets, beneath the surface, there's this focus on operational strength and financial discipline. Let's talk supply chain first. They had a big savings target.
They did, aiming for $90 million in savings this year. And they're well on their way, hit $60 million year to date.
60 million already. Where are those savings coming from?
Pretty evenly spread, actually. Primary distribution,
Yes.
$30, cost to serve, $20, and cost to make, $10, shows they're looking across the whole chain.
Right.
Lots of focus on line efficiency, optimizing things like changeovers between different products and package sizes, just grinding out efficiencies.
And they're still adding capacity even while chasing savings. You mentioned new lines.
Yep, 9 new bottling lines planned for 2025.
Yeah.
3 already started, Mexico, Guatemala, Colombia. 4 more coming in Brazil, plus another one each in Guatemala and Costa Rica later this year. Signals real confidence in future demand.
Okay, turning to the financial side, capital allocation. They issued new debt.
They did. U.S. $500 million in senior notes due 2035. And they got really good terms, attractive spreads, a 5.1% coupon.
Yeah. What does that signal?
Strong investor confidence. Strong international investment-grade dedicated investor demand, as they put it. The market sees them as a solid bet.
But that new debt adds interest costs, right?
It does. That, plus higher rates in Brazil and some new financing in Colombia, meant their interest expenses went up, which did impact that bottom line net income number we saw earlier.
Okay. But despite that new debt, their balance sheet looks healthy.
Very healthy. Net leverage, so net debt divided by adjusted EBITDA, is below 1 time. It's at 0.79. That's very low, very strong.
Almost too strong.
Well, interestingly, the company itself called it potentially an inefficient capital structure, meaning they have so little debt, maybe they could be using their balance sheet more effectively.
Right.
They hinted they might look to address that by year-end or early next year.
Interesting. Maybe more investment or returns to shareholders?
Could be either or both. They did also just pay out an ordinary dividend, TO's 0.23 per share, just recently on July 16th.
And how are they managing CapEx spending in this environment?
They're being quite nuanced. Long-term structural stuff like building plants, warehouses, things that boost efficiency or reduce future costs like freight that continues, they're committed to that.
Makes sense.
But the CapEx that's directly tied to volume, like buying more bottles and cases, they can flex that down if demand is softer. It gives them flexibility. Overall, they're still aiming to invest between 8 to 9% of their net sales back into the business.
Consistent reinvestment. And one last financial piece about FX hedging. Currency swings can be brutal.
Yeah, and they're very active here. For the rest of 2025, they've hedged between 50% and 80% of their dollar-based raw material costs. Mexico's actually at 83%. Brazil between 50–60%.
Locking in costs.
Exactly. And they've even started hedging for 2026 already. Mexico's got 22% hedged for next year, locking in rates around 20 pesos per dollar. It provides crucial stability and protects margins from those big currency swings.
Okay, so wrapping up, looking ahead, the CEO sounded cautious, especially about Mexico for the second half.
Yes, cautious optimism maybe, pointing to negative trends in personal consumption spending and remittances in Mexico as reasons for caution.
But the overall message is adaptability.
Very much so. The phrase was about needing to fine-tune our plans together with our partners at the Coca-Cola Company, constantly adjusting to meet both short-term realities and long-term goals.
And they also highlighted their sustainability work.
Briefly, yeah.
Yeah.
Got included in the FTSE 4Good sustainability indices for the 10th year running and improved their score. It's part of that broader picture of long-term value creation, not just quarterly financials.
Right.
Right.
So this whole deep dive really shows how a massive company like Coca-Cola FEMSA has to juggle, economic swings, unpredictable weather, intense competition, but also how things like digital tools, supply chain tweaks, and smart pricing can make a real difference, even in a mature industry.
Absolutely. It demonstrates that strategic agility is key.
Which really makes you wonder, doesn't it? What do these trends, the digital engagement, the focus on affordability, the fight for share in traditional channels, tell us about where consumer behavior is heading in these emerging markets? And how will companies keep building resilience against all these headwinds, both global and local?